Why you need to be careful when you're investing in dividend stocks. Don't just invest for the yield or the dividend it pays out. You've got to do your research, my friend. So we're going to talk about that here today because this is actually almost this is almost tragic, if you will. And we're going to talk about what you need to do to prepare if your dividend stocks have the same concept or the same problems that we're going to talk about here today. So, welcome to Heritage Wealth Planning YouTube channel, the place where you come to figure out how to invest in dividend stocks. And you know that I'm a fan. I'm a fan of dividend stocks for sure. I gave you I did a thing on a mutual fund which showed you what happened when you did not reinvest dividends to when you did reinvest. And we're talking over the course of a lifetime investing millions of dollars worth more from just simply reinvesting your dividends. So I'm a fan, but you got to be careful. So let's dive right into this. Don't forget to subscribe, by the way. And of course, comments are always helpful because comments tell YouTube, hey, people like this guy's stuff. So comment below. So this is from the Wall Street Journal, just I think it was yesterday. Let's see. Does it say the date on here? Today, I think it's from yesterday, or maybe it's today. GE shows what happens when dividend investing goes wrong. All right. So what? Some guy named James McIntosh, I'm not familiar with. Um, GE is dropped. I mean, it's dropped below $10 a share. If you invested in GE for the dividend, you discovered your mistake on Tuesday when the payout was slashed from excuse me, 12 cents to 1 cent a share a quarter. So you're getting, in fact, I just got to look. What's GD doing today? I guess that was, I read this article yesterday. Let's see what it did for, let's see what it's doing now. So yeah, man, GE. Bear with me just a second. My amigos, that's my friends in Spanish, 929. 929. That's nuts. GE. Yeah. All right, so as the dividend slash was 12 cents a share to 1 cent a share. So what we know, if you bought it today at 1 cent a share, all right, it trades at 9.29. You're getting. Let me get my calculator. You're getting 4 cents a share, and what you do is you take 0.04, divide that by 9.29. Your payout is less than 1%. It's I mean, it's minimal at best, but that's how you figure out what your payout is. So if you have a $10, well, you do a $15 dividend, a $15 stock, and the dividend is $1.50, you take 1.5 divided by 15, and that'll give you a 10% payout rate. All right, so that's how you figure out your dividend payout rate. You take the dividend price or the dividend amount you're getting, divide by the current price of the stock, and that gives you your dividend yield, I should say. That's your dividend yield. Your payout rate is completely different. I'm going to talk about that. So remember, the dividend that it pays, the dollar amount or the pennies, divide that into the price of the share. That is your dividend yield. And the dividend yield is forever volatile because the stock price changes moment by moment. All right, you are in good company in your era. Investors focus far too much on dividends, distorting corporate behavior and making it easy to forget what matters isn't the payout, but whether the business can sustain it. I'd actually say the payout ratio matters. We'll talk about that, but whether business can sustain it, not the actual dividend itself. I would have rewritten this and say the payout. I would rather say what matters is isn't the dividend yield, but whether or not the business can sustain it. Because the yield we just talked about, the payout is actually the payout ratio. I'll just tell you what it is. So if a company makes $100 million in net income and they're paying out $50 million in dividends, their payout ratio is 50%. That's a wonderful mechanism to figure out if they have enough cash in terms of operating business operations to continue to make that dividend payout. So, for instance, GE, we'll just use them. They made $100 million in net profits. Net profits. They don't get to write it off. I can't remember if it's net or gross. I think it's net profits because they don't get to write off the dividend payout because they have to pay it because its dividends are double taxed. They're taxed to you as the investor and the tax to them as income. If I'm wrong, correct me on that. I'm almost positive. I know dividends are double taxed, but I can't remember if they get to write it off. They don't get to write it off as a business expense. All right, so they make $100 million of net profits, and $50 million of those dollars are not reinvested back in the company, but are instead paid out to their investors. That's a 50% payout ratio, which is critically important. So just say they make $100 million in net profits, and $90 million are paid out in dividends to the shareholders. That's a 90% payout rate. And the reason that's scary is what happens if next year they only make $80 million in net profits. How did they make that $90 million of dividend payouts? Well, they either have to go to their cash reserves, hopefully they have some, or they have to borrow, which we don't want, or they have to cut the dividend. One of those three things. Ideally, they just go to the cash reserves. We'd like the dividends to be paid from the operating income they make on an annual basis. But if they have to go to cash reserves, that's the least of the worst, the least worst of the three options. Cash reserves, go to the bond market to borrow some money in order to pay out the dividend, or they have to cut the dividend. Cutting dividend companies don't want to do because the price drops, like we're seeing here. GE cut the dividend because it needs to hoard cash over its structures and shrinks. Yet even the token penny payout is a sign of distortions of the demand that dividend creates. The decision to maintain it is clearly down to the excessive value shareholders play on dividends. I completely agree with that, which is why Apple started paying a dividend. Because people say, you got all this cash, pay a dividend. Well, Apple did it with his cash holdings. They didn't have to do his operating, his net profits, because they got tons of cash. There are plenty of warning signs that dividends was unaffordable. I love when they say there were plenty of warning signs. I wonder if old James McIntosh here told us about the warning signs in the past. I have a high suspicion he did not. Dividends are a way to return profits to shareholders, but GE's net income has been higher than the dividend cost in only 4 of the past 15 quarters. There we go, net income, like I just talked about. So essentially, they were making more money than their dividend payout only 4 of the last 15 quarters, compared with all but 2 quarters in the entire period from 1989 to 2008. So basically from the 20 years previous to these last 10, only 2 quarters did they have net income that was below the dividend payout. And now in the last 15 quarters, they've had 11 times where the income was lower than the dividend payout. Even excluding this week's monster $22.8 billion loss, GE has paid out almost twice as much in dividends as it has made in net income since 2012. That's unsustainable, my friends. Every shareholder should have realized the dividend was getting riskier, even if they weren't looking at the falling amount of cash the business was producing. In parallel, GE cash slashes capital spending, the business has been eating its seed corn recently, basically taking its cash and not reinvest it in further growth, but just to pay the dividend, partly to maintain the dividend. Dividends do, of course, matter. The prospect of eventual future dividends is the main reason shares have any value at all. The reinvestment has accounted for the bulk of long-term returns on stocks. I already talked about that. I don't know if it's the bulk, but certainly it's, I guess it would be significantly the bulk. Absolutely. Stocks return 10% a year, 4% of those years, 4% of the 40% of that 10% is attributed to dividends, but compounding, if you take out the dividend reinvestment, as I showed you in a couple of videos, you're talking huge differences between reinvesting dividends over a long term and not reinvest. We're talking millions of dollars. Better still, dividends can instill discipline on executives, preventing them from indulging their wildest fantasies. So Jeffrey Immelt, for instance, used to fly not 1 but 2 planes. 2 planes. So when he'd go around there saying how green he was, he would fly 2 planes. One would be him in it, and the second one in case the other plane got an error, couldn't run. So he'd have 2 planes to tell about his green chops. These weren't flying electric batteries. But yet he was saying, "Gee, he's so green." But he had 2 planes because if the first one went bad, he'd have a second one he could hop on. Let's see. Chief executives given a free rein and plenty of money have an unfortunate tendency to engage in value-destroying takeovers, build fancy new headquarters, and diversify into trendy new businesses, which they know little. Better to pay dividends or buy back shares than frit away the money. I completely agree with that. However, dividends should be the result of successful business throwing off cash, not something that executives strive to maintain even when the cash flow could be better used. GE is a classic case of the dividend being prioritized and hope that something comes up. I could not agree more. Shareholders, let's see, those eagerly anticipating their next dividend check might be spluttering into their latte at the horror of these views about paying the dividend when you don't have the cash to fund it. But whether the dividend is paid out or not should make no difference to them. Shareholders own the company. When it pays out money to shareholders, it is worth less, which is exactly what I talked about. Don't buy the dividend, because when you're buying the dividend, you are paying tax on the exact same share price. The share price drops, but because the share price drops because the amount of dividends paid out, you're paying tax. Now, the net to you is still the same, but after taxes, you're losing money. Don't buy the dividend. I know I'm not explaining this well here today, but I've done another video on that where the stupidest tax you can pay is buying the dividend. You're going to lose money if you buy the dividend. Don't buy the dividend because, again, what happens, what shareholders own the company, when it pays out, the company pays out to shareholders the dividend, it is worth less. The company has less value because they've spent money to pay out the shareholders the dividend. It's worth less by precisely the amount of the dividend. The shareholder's pocket is unchanged, except for taxes, of course. All right. I actually like this quite a bit. 3-month T-bill yield right here. Look at that. Here's a U.S. stock dividend, 2%, 2%, 2%. 3-month T-bill yield. Look at that. So now dividends are looking pretty attractive here, right? Look at that, though. Now we got the 3-month treasury bill, essentially the cash accounts, which is higher than the dividend with no risk at all. And, well, now this pays tax higher for sure because this tax is ordinary income. But the dividend yield is only taxed at 0 or 15%, depending on your tax bracket. In an ideal world, companies would pay out cash when they have no good use for it and invest in new projects only when justified by future expected profits. In an ideal world, shareholders would trust the board's judgment. All right, demanding a solid dividend has merit as a way to limit implication. Okay, I got it. All right, so the point about this, GE, that's what happens when investing world goes wrong. But the question I have is, how is your company funding its dividend? And I was working with a lady. She had about 70% of her net worth tied up to this one company stock that her dad left her when he died. And it had been good to him for many, many years, since the 60s. And she was somewhat hesitant to liquidate. She was fine when I showed her why. But she was getting a big fat dividend. But when he saw the debt levels going up and up and up and up and up, and their net revenue, net cash flow going down and down, you see the debt going up, cash going down. That is not a good place. That's not a good place for the ships to pass that night for sure. How are they going to maintain the dividend? Well, the answer is, like in GE's case, they can't. So they're either going to do one of three things. They're going to take on more debt. Well, if your debt level is going up, at some point, no one's going to loan you money. They're going to go to the cash reserves. They already, in this case, they're already going into the cash reserves for GE, or they're going to cut the dividend. And when they cut the dividend, what happens to the stock price? It drops like a brick in water, just like what we happen here. So you got to be very careful. Oh, this company is paying a 5% dividend. The 5% yield is twice as high as the average S&P 500. What's going on with that? There's a reason for that. Are they doing it they're funding the dividend with debt? Are they funding the dividend by pulling in the cash? Or are they funding it by their net income? If they're funding it by the net income, that's great. But if they're funding it by taking out cash, or certainly worse, is buying debt, not good. So you got to be careful here, my friends. So just remember the story. This is GE. Not some fly-by-night company trading at $9.24 boggles the mind. And they have no price-earnings ratio. Their PE ratio is below 0 because they're not making any money. It's crazy. All right. Hope this helps. Be careful. And don't forget to subscribe and comment, and we'll see you next time. Thanks, guys.